So you're a trader and you're looking to get funded, right? You want to scale your capital and really take things to the next level. Well, you're in the right place. Today, we're putting together the ultimate playbook for one of the most critical and honestly most misunderstood parts of any prop firm deal, the profit split.
Look, we've all been there. You know how to trade, you've put in the hours, you've sharpened your strategy, but you're stuck, held back by a small account. This is the exact problem that prop firms were created to solve. They exist to give talented traders like you a shot at trading with some serious capital, all without you having to risk your own money. It's the dream for sure.
But here's the thing. That dream, it comes with some fine print. Getting that funded account means signing a contract, and right at the very heart of that contract is the profit split. Seriously, understanding this one number and everything that surrounds it can be the difference between a long, successful trading career and a really frustrating one. Okay, so let's solve this puzzle together, shall we? We are going to break down exactly what a profit split is, how the different types work, and most importantly, how you can use this knowledge to unlock your full trading potential. At its core, it's actually pretty simple. The profit split is just the deal on how you and the firm share the winnings. I mean, think about it. The firm puts up the capital, they take on the risk, and in return, they get a slice of the profits that you generate. It's a partnership, really, designed so that everybody wins. Let's make this real. A pretty standard deal you'll see out there is an 80-20 split. So let's say you have a good run and pull in a $5,000 profit. With this split, you keep 80% of that, which is a nice $4,000 in your pocket. The firm gets the other 20%, or $1,000. See how that works? It perfectly aligns your goals with theirs. When you win, they win. Simple as that. Okay, but here's where it gets a little more interesting. Not all splits are the same, not by a long shot. To really build out your playbook, you've got to be able to decode the main types of deals you're going to come across. So, you're mainly going to see these three flavors. First up, you have the fixed split. It's exactly what it sounds like, a constant percentage. Super simple, very predictable, which is why it's great for beginners who just want stability. Then you've got tiered splits. These are designed to reward big wins. As you hit higher profit targets, your percentage actually goes up. This is awesome for high performers, but you got to be careful. It can create a little psychological pressure to chase those targets. And finally, there's the scaling split. This one is for the long game. It rewards consistency over time. The better your track record, the better your split gets. Knowing the different types is one thing, but let's get to the question that really matters, right? What does all this mean for your actual take-home pay? Yeah, the answer might not be what you think. Check out this example. Let's say you make a $10,000 profit. With an 80% fixed split, you get $8,000. Easy. But a tiered split, well, it might start at a lower percentage for that first chunk of profit. So even though it's built for big earners, on this specific profit amount, you could actually walk away with less. This just goes to show you've got to read the fine print. And that brings us to maybe the most important skill in your entire playbook, figuring out what you actually walk away with. It's time to learn how to turn that gross profit number into your real, actual take-home pay. You have to remember this. That big, flashy 90% split they put on the homepage, that's just the starting point. That's the advertisement. Your real payout is the number that actually hits your bank account after all is said and done. So let's break down how to calculate it. The formula is surprisingly straightforward. You just start with your net profit. Then you apply your split percentage. From that number, you might subtract or, in some cases, get back things like your valuation fee. And finally, you add on any sweet performance bonuses you might have earned. All right, let's run the numbers on a scenario. Imagine you absolutely crushed it for a month, $10,000 in net profit. You're on a fantastic 90% split, you paid a $300 evaluation fee that the firm is going to refund on your first payout, and you nailed a $500 consistency bonus. So, what's the final number? And there it is. Your profit share is $9,000, right? 90% of $10,000. The firm gives you back that $300 fee, and you tack on the $500 bonus. And you're left with $9,200. That is your real payout. That is the only number that truly matters. Okay, you ready? We're at the final page in our playbook. This right here, this is the insight that separates the pros from the amateurs. It is, without a doubt, the single biggest strategic decision you can make when you're picking a prop firm. Now look very closely at this comparison. On the left, you've got a trader with a killer 90% split, but on a smaller $25,000 account. They make a 10% gain, and their payout is $2,250. Not bad. But now look at the trader on the right. They have a lower 80% split, but on a much larger $100,000 account. On that exact same 10% gain, their payout is $8,000. The difference is absolutely staggering.
And that is the whole game right there. The size of your capital is the ultimate amplifier for your skill. A bigger account gives your strategy room to work. It lets you use proper risk management without being choked by tiny position sizes. Don't get distracted by a few extra percentage points in the split. Focus on getting the largest account you can comfortably manage, because that is what truly drives your earnings.
All right, let's recap the playbook. First, always look past the big headline number. Second, know the difference between fixed, tiered, and scaling splits, and pick the one that actually fits your trading style and your psychology. Third, always do the math to figure out your real payout. And finally, and this is the big one, prioritize getting more capital over choosing a slightly higher split percentage. And that really just leaves us with one final question for you to think about. As you're looking at different prop firms and you're comparing all their offers, just take a second and ask yourself, are you chasing the right number?